When approaching retirement, you might have questions about retirement income, about investments, and then there's the questions about tax. In today's episode, we're going to talk about the 7 tax questions people approaching retirement, people just like you, are asking. We're going to help you understand what does and does not get taxed. We're going to help you understand where it may or may not get taxed, and then help you understand how to prudentially reduce the overall taxes when it comes to retirement.
Welcome to the Your Life, Your Money podcast with Scott Searens, teaching you how to thrive in life, wealth, and retirement.
Welcome to the Retirement Show, all about your life, your money, and well, today our focus is actually going to be on your taxes. I'm your host, Scott Searens, and my goal is to help you thrive in life, wealth, and retirement. As I mentioned, today we're going to talk about your taxes, and specifically, we're going to talk about the 7 tax questions that people approaching retirement, people just like you, are asking. Folks, when it comes to retirement, I think there's what I'm going to call the simple retirement formula. The simple retirement formula, if you think about a mathematical formula, we're going to have our what's coming in on top. Okay, on our mathematical formula here, our retirement formula. On top, we're going to have what's coming in. That's going to be your income, your Social Security, your pension, your rental income, your business income. That's going to be our top number. Then we're going to subtract out. Can you guess what it is? Yep, exactly. Today's topic, we're going to subtract out taxes. So we take what's coming in, subtract out taxes, and that is what you keep. So if we can help maximize what's coming in, help minimize taxes, what's going out, well, that's going to help maximize what you keep in your retirement. That's going to help maximize and help you keep more in your pocket. It's going to help you have more for your lifestyle, have more for your hobbies, and help you have more for travel and all of the fun things that you want to do in retirement. So it's no surprise that as people approaching retirement, people just like you, they come in with a lot of tax questions and potential tax concerns. From questions from understanding what are the implications of withdrawing money from their retirement accounts to how do they help minimize taxes on their investment income. It can all seem and feel very overwhelming. So what I thought we'd do is in today's episode, we're just going to break down the 7 tax questions that people approaching retirement are asking. Now, as we break down these 7 tax questions, what I thought could be helpful, because at the end of the day, too, one of the questions I always find is, well, how much am I going to get taxed? How much am I going to pay in taxes? So we're going to go through the tax questions, but at the same time, I want to answer that other question of, well, then what does all of this mean to me? How much taxable income will I have coming in? So what I want you to think about, or just imagine, and go back to your high school or junior high days when you were in science class and you're working with those science cylinders. And if you think about it, right, the science cylinders, you'd fill them up with liquid, and the liquid would go up. There's numbers on the side that would count up to tell you how much is in that cylinder. Well, in today's episode, we're going to make our own tax cylinder. How's that? And you're going to fill it up with imaginary dollars. The reason I say imaginary dollars is because when I say to put imaginary dollars into the tax cylinder, that doesn't mean that's money going out in taxes. It's just how we're going to help you figure out how much taxable income you will get taxed on. And so as we go through today, I'm going to say, that's where you want to put some more imaginary dollars over into the tax cylinder. And then you can mentally add up how many imaginary dollars you'll have in your tax cylinder and know how much you'll be getting taxed on, or have a good estimate of how much you'll be getting taxed on at the end of the year. Okay, so breaking down the 7 tax questions people approaching retirement are asking. So one of the tax questions that we get is, what are the tax implications of withdrawing money from my retirement accounts? Well, let's focus on retirement accounts here. A pretty vague word, right? So we got to break that down. There are Roth retirement accounts. Now that could be a Roth IRA, Roth 403B, Roth 401k. Now, when you take money out of a Roth account, it comes out to you tax-free. The money that you put in comes out tax-free. The gains come out tax-free. So when it comes to taking money out of the Roth account, good news here. You take money out of the Roth account, no imaginary dollars need to go into your tax cylinder. So good news. That's why a lot of people like the Roth. Does it make sense to focus on the Roth versus the regular? That's not for today's discussion, but just know when you take money out of the Roth, it's going to come to you tax-free. Okay, so the other types of retirement accounts here, and I think this is where most people have a lot of their money saved, and so it is a very important question. The 401k, the IRA, the 403b, the 457. When you withdraw money from any of those accounts that I just listed, all of that money would be considered taxable income. All of it will be taxable. At what rate? Well, again, that's going to depend how much you have in your tax cylinder by the end of the episode here. But just know all of it would be considered taxable at your ordinary income tax rate. So let's just say you're taking $25,000 out of your IRA. Well, we need to put $25,000 imaginary dollars over into your tax cylinder. So remember, it gets taxed. Because it gets taxed, we now have to put $25,000 imaginary dollars over into your tax cylinder. All right, another question that we get asked quite often is, does the taxation of my pension income differ from other forms of income? And I guess I should have said from the beginning here, my main focus when chatting with you in regards to taxes is in regards to federal taxes. I mean, that's kind of where we find the main bill in your retirement will be. And so our answers here are really wrapped around federal taxes. So back to this question, does the taxation of my pension income differ from other forms of income? Typically not, no, meaning that your pension income will be taxed at your ordinary income rates. However, depending on your type of pension and how it came to you or what you might have going on, always chat with your financial professional and your tax preparer. But typically, your pension will be taxed at your ordinary income rate. So back to our tax cylinder, let's just say you have $50,000 coming in each and every year in regards to pension income. I know pensions are pretty few and far between anymore, but if you do have it coming in, good for you. You have $50,000 coming in to your checking account and pension income. Well, guess what? Now you've got $50,000 imaginary dollars that you're going to have to put over there in your tax cylinder as well. So we've got the $50,000 from the pension income. We've got the $25,000 that you took out in the IRAs. We've got $75,000 imaginary dollars sitting over in the tax cylinder. All right, the next question people approaching retirement are asking is, will my Social Security benefits be taxed? And the answer to that is maybe, and it depends. And what it depends on is your modified adjusted gross income. Now, we're not going to go into how to figure your modified adjusted gross income today, but just know your tax preparer will be happy to figure that number for you. And then depending on what that number comes out to be, you might not have to pay any tax on your Social Security, or potentially up to 50% or maybe up to 85% of your Social Security will get taxed. No, they're not taking 85% of your Social Security. It just means 85% of your Social Security adds into your taxable income and will get taxed at your ordinary income tax rates. So let's just keep this simple. Let's say your tax preparer got back to you. Yep, based on all of the other income that you have coming in, looks like 85% of your Social Security is going to get taxed at ordinary income rates. Let's say you've got $50,000 of Social Security income coming in. Well, we take that times 85%. That means we've got $42,500 going over into your tax cylinder. When we add that in to your $25,000 of IRA withdrawals, and then again, we've got $50,000 of pension income coming in. Next thing, we've got $117,500 imaginary dollars sitting over in your tax cylinder. All of that's going to feed into how much you get taxed. Okay, now we're going to come back to the tax cylinder, but let's just kind of move on to a few other questions. And before I do that, and since we're talking about taxes, folks, I just want to make sure that if you haven't yet, I want you to get our free guide to unlocking hidden tax savings opportunities. You can get this at our website, lifemoneyshow.com/taxes. Again, that's lifemoneyshow.com/taxes. It's a guide of strategies to help you reduce your taxes. It's going to provide you actionable advice and a checklist for you to utilize to make the guide specific to you. But more importantly, what it means is it's going to help you understand how to reduce what you're paying to the IRS and keep more of your hard-earned income, more of your hard-earned retirement savings in your pocket versus paying it to the IRS. We want you to only pay what you legally have to without leaving the IRS a tip. There you go. All right, so again, you can get that at lifemoneyshow.com/taxes. So back to our 7 tax questions that people approaching retirement are asking. Our next question, the question, I guess would be the question number 4 on the list here as we're going through, is can you potentially create any sort of tax, call it problems or taxes when you sell your primary residence? And let's just say as you go into retirement, maybe you're going to sell your primary residence and you're going to downsize. Maybe you're going to rent for a little bit. Maybe you're going to move to another location. So when you do that, will you be looking at any sort of taxes that you should be aware of? Well, the answer, again, is maybe, and it depends. And you see, a lot of times the taxes would be if you had gains, meaning you bought the residence for $500,000, now it's worth $700,000, there's $200,000 of gains there. Are you going to have to pay tax on those gains? And that's why I said it depends. Now, based on IRS rules, a single has an exemption of up to $250,000 of gains on the primary residence. A married couple has a $500,000 exemption. What do I mean by this exemption? Well, as long as it was your primary residence and you've occupied it for at least 24 months out of the last 5 years, and that sounds very specific because it is, and because it's part of the IRS rules. You've had to occupy it for at least 24 months out of the last 5 years. So if you have met all of the qualifications and the rules, then you may not owe tax on the gains. Let me walk you through an example here. Let's just say you're a single person. You bought your house March 31st of 2021. And when you bought it for $500,000. You sold it on April 1st, 2023 for $700,000. Well, that's $200,000 of gains. Right there, your mind's probably going, oh my gosh, I don't want to pay tax on $200,000 of gains. Well, in this scenario, and let's just say it was primary residence, and for those 2 years you lived in that property. Well, since it was 2 years and 1 day when you sold it, because it's under the $250,000 exemption for singles, then you don't owe tax on any of the gains. Pretty great, right? From a couple's standpoint, that same exemption would have been $500,000. Now, let's just say it was sold for $800,000. Well, you take the $300,000 of gains minus the $250,000 exemption. Now you do owe tax, and you're going to owe tax on $50,000 of gains when it comes to that sale. Another example of when you might owe tax on the sale of that home is, let's just say you bought it March 31st, 2021, but you sold it February 28th of 2023. Well, you didn't meet all the qualifications of being there for 24 months, so you would owe tax on the gains. Now, depending on how long you're in the house, that could be the difference between long-term gains and short-term gains. Just know there's some great rules out there when it comes to selling your primary residence that you can utilize to hopefully keep more of your gains in your pocket versus paying it out to the IRS. Okay. Here's another question that we get when it comes to taxes. I told you today was basically, our thoughts and comments and discussions were around federal taxes. But one of the questions that we get is, how will my taxes change if I decide to move to another state once I retire? And I've, had a few clients that have done this. And one of the things that you really want to check into is when you move to a different state, what does that state tax? Are they going to tax your Social Security? Are they going to tax your retirement income? Are they going to tax your pension? Every state has different rules. So I had a few clients, they moved out of Illinois and they went to another state where that state actually did tax their retirement income. And when they thought that they were leaving our state, because we have super high property taxes, They thought they were leaving. They were going to get away from the super high property taxes of Illinois and go to another state. Well, then once they started paying all those state taxes on their retirement dollars, next thing you know, it kind of all evened out. So, yes, moving to a different state could potentially cause you extra taxes. Or if you're in a state that is taxing retirement income, moving to a state that doesn't could save you in retirement taxes. There you go. Always trying to find the positive. Depends on where you're at and where you're going to. So to answer that question, I think you always need to look at what state you're going to and what they'll tax as far as retirement income. Okay. Next question out of our 7 tax questions people approaching retirement are asking is, when giving money to charities or to family, are there any tax benefits for making those contributions or those gifts in retirement? What are the tax considerations that I should be aware of? Let's kind of split these up because I think that they're separate. And we're actually at the same time going to go back to our retirement tax cylinder. So if you remember in our first 3 items with the IRA, the pension, and then the Social Security, we're putting imaginary dollars over into our tax cylinder. And those imaginary dollars added up to $117,500. Now, before I kind of go into answering question number 6, just know that each of us, whether you're a single or a couple, you get a standard deduction. Now, that standard deduction is different for singles and couples, and it's also based on how old you are. So let's just say our example here was for a couple. They're married, filing jointly in 2023. The standard deduction is $27,700. So what does that mean in regards to your tax cylinder? Well, what it means is all these imaginary dollars that you've poured into your tax cylinder or put into your tax cylinder, that $117,500, well, now we can actually pour some out. And what we can pour out based on that standard deduction is $27,700, and that gets you $89,800. Now, folks, this isn't exact, and again, this is why, as you go through your taxes, there's lots of questions. I'm just making some very general approaches today in regards to helping you figure out your overall taxable income. But all of those monies, those imaginary dollars that we put in, then your standard deduction, you get to pour some out. And so your taxable income then is $89,800 in this hypothetical example. So what does that mean? Does that mean you have to pay $89,800 in taxes? Nope. That's then where you go to the tax brackets. So for instance, married filing jointly 2023, the first $22,000 of that $89,800 is taxed at 10% from $22,000 to the actually $89,450 is taxed at 12%. And then the next bracket there, so basically the $89,450 to the $89,800, what's that? That's $350 will be taxed at 22%. So hopefully that just helps you understand a little bit more in regards to taxes. Was that specific and exact? No. You doing your own taxes or working with the tax preparer will figure out those specific numbers. But it hopefully gives you an idea then of where taxable income comes from and how much. So now back to the thoughts about giving to charity. And I wanted to cover standard deduction first, because what I find is a lot of times the standard deduction is more than what people are giving to charity. So, are there tax benefits to giving to charity in your retirement? Well, it's going to depend on a lot of different things, but let's just say you're younger than age 70 and a half. Are there any sort of tax benefits? Well, you would have to give more than 27, in our example here, married filing jointly, you'd have to give more than the 27, all of your deductions, including your charitable contributions. So not just charitable contributions, but all of your deductions would have to equal more than that $27,700 for you to get a tax benefit from doing that. However, there are some other ways to do it. One is a donor advised fund where you can put multiple years of charitable contributions into a pot that then exceeds the standard deduction, and you can take that deduction in 1 year. I'm not going to go into the details of that. Just know donor advised funds, one way to do it. Then the other way to potentially do it, let's now say you're age 70 and a half or older. You can do what are called qualified charitable distributions. That's where you give directly from the IRA to the charitable organization. So let's go back to our $25,000 example that you're taking out of your IRA. Remember when you took those $25,000 out, I told you to add $25,000 imaginary dollars over into your tax cylinder. Well, if you gave $5,000 of that directly from the IRA, again, you're age 70 and a half or older, straight to the charitable organization, now instead of putting $25,000 into the tax cylinder, you're only going to put $20,000 into the tax cylinder. So you can see right there how it's going to help reduce your taxable income. So the second part of just, giving money, whether it's to charity or to family, gifting money to your family, there's no tax, I'll say, deductions for doing so. But here's where maybe the tax benefits come in. If you plan to give or help out your family, if the money's sitting in your brokerage account, your joint account, your trust account, your individual account, where the dividends and interest are causing capital gains and taxes for you each and every year, well, if you gift that to your children, then guess what? You don't have those gains and interest adding into your taxes every year. So that's one of the benefits that could potentially be looked at from a tax standpoint, but I just didn't want you to think that you're going to get a tax deduction, that you'd actually be able to pour more of those imaginary dollars out of your cylinder by giving to your children. Okay, and then the final question, but probably a question that we get a lot from those approaching retirement is, should I do a Roth conversion now, or should I wait until retirement? So it depends. And I think as we've used this imaginary tax cylinder as we've gone through today, you can kind of utilize this to help you think about, should you do a Roth conversion or not? I want you to think about how much you have in your tax cylinder, how many imaginary dollars are over there in that tax cylinder. Then you kind of got to say, okay, here's my tax cylinder today, and here's what the level of it is. What's the level of it going to be once you retire? But then also, what's the level of it going to be once you turn age 73 or age 75, when you have to start taking those required distributions? What's it going to look at age 80 or age 90 or age 95, when the rate of how much you have to take out of your IRAs and 401ks goes up and you're taking more money out of that taxable income out? So that's where tax planning and tax projections, all of these questions is where tax planning and tax projections come in, but especially when it comes to Roth conversions, because you want to understand what the level of your cylinder will be at each and every one of those different ages. And if your cylinder is going to be at a higher level in the future than where it is today, well, then it might make sense to pay tax today. Do that Roth conversion. When you do a Roth conversion, you pay tax today at a known rate, and you get it over into that tax-free bucket. So if your level is going to be higher in the future, might make sense to add some to your cylinder today and pay tax today at a lower level. So for some, it makes sense you do the conversion today. For others, when you look at this, it might make sense to wait till you retire and then do Roth conversions from the time you retire until when you start taking required minimum distributions. And then for some others, as you do your cylinders and kind of look at the different levels from today versus retirement versus in your 80s and 90s, the level might be lower in your 80s and 90s. And then if so, then it doesn't make sense to do any of those Roth conversions. So this is really dependent on your tax plan and your tax projection. This is something that we look at for all of our clients, project up on the screen for them so we can help them make sound decisions when it comes to whether or not they should be doing Roth conversions today, Roth conversions at retirement, or not be doing Roth conversions at all. Hey, I hope today really helped you in regards to different tax questions that we find are on the minds of people just like you. And if so, don't forget to subscribe to our podcast on your favorite podcast player. Also, if you haven't yet, download your free guide to unlocking hidden tax savings opportunities. You can get it at lifemoneyshow.com/taxes. Again, it's a guide of strategies to help you reduce your taxes. It's going to provide you actionable advice and a checklist to utilize so you can make it specific to you to help you reduce what you're going to pay to the IRS and help keep more of your hard-earned income and hard-earned retirement savings in your pocket versus giving it to the IRS. Again, you can get that at lifemoneyshow.com/taxes. Hey, I look forward to our next episode to continue to help you build wealth, reduce your long-term tax picture, and help you in regards to retiring with less stress. So, look forward to our next conversation to help you enjoy life today and be financially confident about your retirement.
Insurance products are offered through the insurance business Sierens Financial Management, Inc. Sierens Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Sierens Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences, including, but not limited to, a need for additional tax withholding or estimated tax payments, the loss of certain tax deductions and credits, and higher taxes on Social Security benefits and higher Medicare premiums. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.